Welcome to Friends, Family, and Angels, Pre-Seed Funding Basics. This is the second episode of our Funding Your Company module, part of the Starting a Company series. We will discuss how to approach early capital, structure deals, and understand angel investors. This program is brought to you by the Series of Thoughts team. Today we'll cover 4 key areas: friends and family rounds, the angel investor profile, finding and approaching angels, and term sheet basics. These steps will guide you through securing your earliest funding. Chapter 1 is dedicated to friends and family rounds. This initial capital comes from people who believe in you most. Getting it right can launch your company. Getting it wrong can fracture important relationships. The cardinal rule of friends and family rounds is never take money from someone who can't afford to lose every single dollar. This is practical and ethical. If the loss would meaningfully hurt their life, decline the money gracefully. The emotional weight of their risk will impact your business decisions. Avoid common mistakes. Don't raise too much. Aim for only 6 to 12 months of runway. Never keep it informal. Always use a signed legal document. Be explicit about the high probability of loss, so investors go in with clear eyes. Finally, maintain ongoing communication to build trust. The goal is to raise enough to buy time to prove something, your next milestone. A typical friends and family round ranges from $25,000 to $150,000. Calculate your burn rate, identify 1 to 2 fundable milestones, and raise enough to hit them with a 20% buffer. Don't raise more just because you can. When structuring the deal, you have 3 options: a loan, a safe note, or a convertible note. For most early-stage founders, the safe note, based on Y Combinator's standard template, is the cleanest, cheapest, and fastest way to document these early investments. Chapter 2 is about the angel investor profile. Angel investors are individuals, often successful entrepreneurs or executives, who invest their own personal capital. Understanding their motivations and who they are is the first step toward building successful funding relationships. Angels and VCs differ significantly. Angels invest personal capital with smaller checks and faster decisions, focusing on pre-seed and seed stages. VCs manage institutional capital, write larger checks, take longer for decisions, and have a more formal diligence process. Angel investors are motivated by financial returns, aiming for 10x or 50x successes. They also seek access and excitement by being close to cutting-edge companies. Giving back and building their network are additional drivers for many angels. Angels look for a great team first, betting on the founder's drive and expertise. They also need evidence of demand or attraction signal, even without revenue. Finally, coachability is key. Intellectual humility and adaptability are essential. The angel's decision framework moves from qualify to commit to engage. Angel decisions are personal and fast, often moving from first conversation to sign safe in under 2 weeks. Momentum is extremely important at this stage. Chapter 3 covers finding and approaching angels. The biggest mistake is waiting until you need money to start building relationships. Begin now. The best angel relationships take months to build, not days. Use networks like AngelList, LinkedIn, and Founder Networks to find investors. Local angel groups and accelerator networks are also powerful resources, providing access to angels who are actively investing. Warm intros are the industry standard, dramatically increasing the likelihood of engagement. To get them, identify investors, find second-degree connections, ask for a specific intro, and write affordable email. Cold outreach should be short, specific, and show your homework to have any chance of a response. Building a network for warm introductions takes weeks to months. Start before your raise, attend events, contribute to online conversations, and help other founders. This goodwill converts into introductions when you need them most. When crafting your first investor message, lead with a specific hook showing you've done research. Describe the problem clearly and concisely in 1 sentence. Show your earliest signal, like a few users or a waitlist. Finally, make a clear, small ask like a 20-minute call to lower the barrier to saying yes. Chapter 4 focuses on term sheet basics. You don't need a law degree, but you must understand the financial instruments you are signing. Decisions made now will ripple through every future funding round. Reviewing the 3 instruments. The safe note is best for pre-seed and angels due to its low complexity and minimal legal cost, deferring valuation until you have leverage. Convertible notes and priced rounds are typically reserved for later, more established stages. A safe note, or simple agreement for future equity, is not a loan. It grants the investor the right to future equity at a discount or capped valuation. Its elegance lies in having no interest rate, no maturity date, and no board seat. Use Y Combinator's free industry-standard templates. Founders must know 4 key terms. The valuation cap is the maximum valuation at which an investor's note converts. The discount rate is a percentage reduction off the next round's price. Pro rata rights give investors the option to maintain their ownership. The MFN clause ensures early investors get the best terms offered later. The valuation cap protects early investors by ensuring a conversion price based on the cap or the Series A price, whichever is lower. Setting the right cap is critical. At pre-seed, caps typically range from $2 million to $8 million. The discount rate rewards early investors for risk by reducing the next round's share price, typically by 15 to 20%. If a SAFE has both a cap and a discount, the investor gets the, quote, more favorable term, maximizing their shares. Most founders offer a cap only for simplicity. Pro rata rights allow angels to maintain ownership in future rounds. While angels want them, founders should be selective as too many small investors can complicate later funding. A compromise is granting these rights only to angels who invest $50,000 or more. The most favored nation, or MFN clause, protects early angels. If you later offer better terms to a new SAFE investor, existing MFN investors automatically receive the same upgrade. This is common before firm terms are set for an official round. Chapter 5 covers how much to raise and what to spend it on. Raise too little, and you fail to hit milestones. Raise too much, and you dilute your equity unnecessarily. Strategic budgeting is essential. To size your round, first, define your next fundable milestone. Then, build a bottom-up budget for expenses. Next, add a 25% contingency buffer for unforeseen costs. Finally, sanity check the total dilution. Aim to keep it under 15 to 20%. Most pre-seed capital should be used to reduce your biggest business risk, typically building a desirable product. The majority of the budget goes to salaries and contractors. Keep non-personnel spending lean and ensure every dollar is traceable to a specific milestone. Prioritize spending on building the minimum viable product, acquiring your first customers, legal and corporate setup to prevent later problems, and key early hires who close critical skill gaps. Avoid wasting money on fancy office space, premature paid marketing before achieving product market fit, overhiring, or excessive tooling and software. Keep your burn rate low and focus resources on product development and customer validation. This chart shows how to model your pre-seed runway. Start your next fundraise when you have 3 months of runway remaining, not 3 weeks. Fundraising takes 2 to 4 months, and desperation kills your negotiating leverage. Now let's put this together into a coherent pre-seed fundraising strategy. Knowing the mechanics is only half the battle. The other half is executing with consistency and a clear narrative. A pre-seed fundraising campaign spans about 6 months. Months 1 and 2 focus on building the foundation. Finalize your pitch deck, create your target list, and begin building relationships. Month 3 is a soft launch with your warmest contacts to sharpen your pitch. Months 4 and 5 are the full campaign, building momentum and deploying your full outreach. Month 6 is for closing the deal, signing the safes, and getting the wires in the bank. Momentum matters because angel investing is deeply social. When investors see other smart people committing, their conviction rises. Use effective tactics like closing your first check early, mentioning confirmed investors, setting a close date, and providing regular progress updates. What should you prepare for the investor data room? Key documents include your 10 to 12 slide pitch deck, an 18-month financial model, a clean cap table, all legal documents, and a product demo or high-quality screenshots. Avoid red flags that repel angel investors. These include unrealistic projections that destroy credibility, dismissing competition, displaying any hint of co-founder conflict, and offering vague explanations for the use of funds. Let's review the pre-seed landscape key stats. The median pre-seed round is $500,000, with a typical valuation cap between $3 and $8 million. Rounds typically take 2 to 4 months to close, and cold email response rates are extremely low, underscoring the need for warm introductions. Angels will ask 4 common questions. Why you? Focus on your unique insight and experience. Why now? Explain the market change that makes this the right time. What's your unfair advantage? Define your defensible edge. Finally, what if X competitor enters? Show you have a durable strategy. To follow up well, Send a personalized thank you within 24 hours and share the data room link if there's interest. Follow up with specific progress updates to tip the decision, and always ask for introductions, even if they pass on investing. In this video, we covered friends and family rounds, emphasizing clear communication and formal documents. We explored angel investors who bet on the team, market, and coachability. We discussed finding angels through warm introductions and the use of safes, knowing your cap and MFN clause. The 5 rules of pre-seed fundraising are: start earlier than you think, protect relationships above all, keep documents simple using standard safes, build momentum intentionally starting with warm yeses, and raise to a specific milestone, not just a number. Your action items this week include listing potential family and friends investors, reading the YC Safe template, drafting an angel list, and identifying 5 people for warm introductions. This month, attend a startup event, build a simple financial model, define your next milestone, draft a forwardable intro email, and set up your basic data room. For additional resources, check out YC's Safe Documents for Templates and Angel List for investor profiles. I recommend the book Venture Deals for Term Sheet Knowledge and the How I Built This podcast for founder stories. Up next in episode 3, we dive into seed rounds and institutional capital. This will cover how to approach seed stage VCs, what a professional term sheet looks like, and how to negotiate key terms.